Good morning, everyone. This is C. Amit Bhatia. In the last session, we had started with international financial management, and now we are going to continue on solving the sums. Last time we had solved basically two varieties of sums. The first one was essentially about GDR, ADRs, right? Now the second variety, essentially, which we are solving currently, is on capital budgeting predominantly, however, with the forex element being involved, right? So today we are going to first of all start with question number 7, where we are going to have again another question on capital budgeting with international implications. Let's start with question number 7. It's there on the screen for you. We have already shared this assignment with you earlier. XYZ Limited, a company based in India, manufactures very high quality modern furniture and sells to a small number of retail outlets in India and Nepal. It is facing tough competition. Recent studies on marketability of products have clearly indicated that the customers are now more interested in variety and choice rather than exclusivity and exceptional quality. Since the cost of quality wood in India is very high, the company is reviewing the proposal for import of wood in bulk from Nepalese supplier. The estimate of net Indian and Nepali currency cash flows in nominal terms for this proposal is shown below. So we have net cash flow in millions provided to us. We are given year is 0, 1, 2, 3. Nepali currency cash flows are given to us in the first year, or 0 at the beginning of the first year is minus 25 million. And then you have positive cash inflows. In Indian rupees, we are given the cash inflows in the first, second, and third year respectively. The following information is relevant. XYZ Limited evaluates all investments by using a discount rate of 9% per annum. All Nepalese customers are invoiced in Nepali currency. Nepali currency cash flows are converted to Indian rupee at the forward rate and discounted at the Indian rate. So converted to Indian rupee at the forward rate and then discounted at the Indian rate. So we are talking about the discounted at Indian rate of required rate of return in India, right? And what is that particular rate given to us? In the very first line, it says by using a discount rate of 9% per annum. So first of all, we will convert Nepali currency cash flows into Indian rupee, and then we will discount it at the rate of 9% per annum. Inflation rates in Nepal and India are expected to be 9% and 8% per annum respectively. The current exchange rate is Nepali currency 1.6 is equal to 1 rupee. Assuming that you are the finance manager of XYZ Limited, calculate the NPV and modified internal rate of return of the proposal. You may use following values with respect to discount factor for rupee 1 at 9%. So we are given basically the discount factors for year 1, 2, 3, and then we have also been provided with the future values, right, at the rate of 9%. All right. Let us first of all start over here. The most important element which you need to pay attention is we are told all the cash flows are given in nominal terms. What do you mean by nominal terms? At the prevailing purchasing power. So that, say for example, this is 4,100. So this is already after inflation, right? There is no inflation adjustment over here. All right. Let's start now. So first and foremost, we start with your, we have cash flows. So first of all, I'm going to take cash flow in Nepali currency, right? Then I have to convert that Nepali currency cash flow into Nepali currency cash flow will have to be converted into INR cash flow, right? So I would need that. But to convert this, I am going to need a particular rate. What is that? I would be needing the forex rates, right? Now this will help me convert my NC INR cash flow. I also have another cash flow which is in India itself, right? INR based. So whatever is my total cash flow now, that will have to suffer the discounting, right? So then I will multiply that with PV factor, which is given at the rate of 9%, and I will have my PV value, right? So what is my objective? My objective is, first of all, get the Nepali currency cash flow, use the forex rate, convert that into INR, which is already being mentioned to us in the information one itself, right? Then I need to discount this at 9%. So rather than taking individually both the cash flows and discounting them, what I'm going to do is I'm going to take INR cash flow also, because I also have an INR cash flow here. Take the total cash flow and then discount it at 9%, right? So here I have 0, 1, 2, and 3. Now here it's very important, before we pursue further ahead, you will need to mention over here amount in millions, right? Here this is very important in my experience, for a simple reason. When I was a student in CA, and we had to write certain CCs, complementary your CC exams, the 3 CC exams we used to have. And that time, once I had missed out on writing this amount rupees, and I remember my faculty had essentially deducted 50% of my marks, though everything was correct, because his argument, which was very logical argument, was, I do not know whether this is rupees, dollars, or stones. And that is the reason, as chartered accountants, we need to be very, very specific, right? So we write over here amount in millions. This is already written over here as well. So I'm going to write over here amount in millions, right? All right. Now let's start. So my Nepali cash flow, first of all, it is outflow of 25.00. Okay. So I'm going to take this and add 0 over here. Okay. All right. So it was minus negative 25. Then I have 2.600. Then I have 3.800 and 4.100. Are you all with me? Able to follow this? So far, I have not started doing any computation. I'm just putting the actual given information, doing nothing beyond that. Just putting the given information to use. Mamta, are you able to follow? Mamta, Nisha, Usha?
Yes, sir.
All right. Now, we go to the forex rate. Now, in the forex rate, obviously, I am going to first of all start with the spot rate, right? So, how do we go about computing the spot rate over here? Do I have the spot rate already given to me? You can see over here, we are given, right? Rupee 1 is equal to NC 1.6. So, I'm given over here, forex rate is given to me as NC upon INR, right? Which is 1.60. Let me take this as 3 numbers, okay? 1.600. Now, since I am being provided with interest numbers or inflation numbers, what is being provided to me of the two countries? Because to get the forex rates of forward, that is after 1 year, after 2 years, after 3 years, I am going to use either IRP or PPP. What is IRP? Interest rate parity, or I am going to use purchasing power parity, which we have done in the previous session as well, right? So I need to convert my forex rates. So first and foremost, 1.6. Remember, this is Nepali currency. So Nepali currency is in the numerator and denominator is INR. So I have to multiply Nepali currency with interest rate which is prevailing in the Nepal. What is the interest rate prevailing in Nepal? Inflation rates you are given over here in point number 2, information, 9% and 8% per annum respectively. 9% in Nepal, 8% in India. So I'm going to say it is into 1.09 divided by 1.08. Right? Now, the new forward rate 1.615, multiply that by 1.09 divided by 1.08 again, and again 1.630 to be multiplied with 1.09 divided by 1.08. Now, when you are doing this with calculator, you can always make 1.09 into 1.08 as a constant, right? And then you can do the computation. It will become a lot easier for you. You just keep pressing equal to thereafter and your life will become a lot easier. Okay. All right. So now I have got the forex rates converted. Okay. Now these are INR cash flows, right? Now I need to convert this Nepali currency cash flow into INR cash flow. So I am going to, should I multiply or divide? Should I multiply or divide?
Going down the ladder.
Up the ladder, multiply. Down the ladder, divide, right? So here I am going from Nepali currency to INR. So I am going down the ladder. So it will be divide. So divide by 1.6, right? So I do the same thing for all the cash flows. Now here you can see there are, obviously in Excel you will get multiple decimals as such. You may always keep this limited to 3 digits or 4 digits max, right? All right. Now, what will be my total cash flow? Total cash flow will be the Nepali currency cash flow, which I have already now converted into INR, plus my Indian cash flow. So that will give me the total cash flow in INR terms. Am I right? Total cash flow, this will be in INR terms. Are you all with me till here? Yes. Is everyone able to follow so far? Yeah. Next is PV factor. We need to discount these cash flows at 9% discount rate, right? Which was already mentioned in information 1. So I'm going to take this PVF factors from here. Now, should I take the PVF factors of the first column or the second column? The future value or the present value, the discounting factors?
Present value.
It will be this, right? 0. So for the first year, remember at the beginning of the year, it's always 1. And thereafter, the discounting applies. So had it not been given, we could have still computed that also by saying 100 divided by 109, right? However, here specifically the numbers are given to us, so we are going to follow those numbers. 0.772. So now I multiply the total INR cash flow with the PV factor at 9%, which is the discounting factor. I do the total. I am getting minus 0.54255. Is everyone getting this? Now, probably if you are taking only 3 decimal points over here, especially in the inflows, then your answer will be slightly different. Is everyone getting this? This is net PV, right? Net present value, NPV. Normally, we are asked to comment based on this, whether you would recommend the project or not. Here, we are not asked to do that. Question is saying, assuming that you are the finance manager of XYZ Limited, calculate the NPV and modified internal rate of return of the proposal. So we have to calculate modified internal rate of the return as well. However, we don't have to comment about whether we should accept the project or not. Had that been asked, you would have said no, right? Because my net PV, NPV is negative. So you would have said we should not accept this particular project. Right? Good morning, Ginny. Are you there?
Yes, sir. Good morning.
Okay. So I hope you are able to follow this, right? The first part is being computed by us, which is we had to compute what is the net present value. So with that we have done. Now, how do we go about calculating modified internal rate? Now, remember, for modified IRR, you will need to first of all map all the cash flows, right? So I will need to again do the mapping of all the cash flows. Once I have done that, remember year-wise, then I will be able to identify what will be the modified internal rate of return. Okay? All right. So first of all, again over here, I will need to go as per the years. So my first column is going to be year 0, 1, 2, 3. Year and then my cash flow. Did we already calculated the total cash flow? Have we already calculated the total INR cash flow? Yes. What is my total cash flow? So I can just copy paste it from here. Now remember, I am on the system. You will need to note it down. So you may please note it down. You just have to copy it from here. Your total INR cash flow. Now here we have to calculate modified cash flow, right? Modified IRR. Had it been a simple IRR, we would have just taken these numbers and calculated the IRR, right? That would have given me the internal rate of return. But we need to calculate modified IRR. Now, what is the difference in that? Modified IRR basically assumes that whatever is your cash flow in the interim, at the end of year 1, at the end of year 2, so on and so forth, will get reinvested into the business and will also have to generate the same rate of return, which is over here 9%, right, for me, because my discount rate is 9%. So I am going to essentially require my modified cash flows over here. So what will be my modified cash flows? At the end of year one, if I am getting X, then that means since it is a 3-year project, this amount is reinvested into the business for 2 more years, right? When it is invested for 2 more years, it is supposed to generate what rate of return? Again, at the rate of 9%. So here we will be using future value, right? So I need to essentially multiply this particular number with 2 more years for returns perspective. I repeat once again. So I will have over here reinvested money, right? And what will be the cash outflow of that? That I will need to compute. So what do you mean by reinvested cash flow? So at the beginning, obviously, this is already invested by me. So at the beginning of the year, this is already invested. This will remain 0. But the year one cash inflow which is coming, remember this inflow is coming to you at the end of year one, right? So I am reinvesting that particular cash flow because it was not withdrawn per se. And in modified IRR, we are trying to identify when the amount gets reinvested into the same business again, then what will be the outcome? So here I need to have the value that if this 4.47909 was reinvested into the business, then for 2 more years, this will generate what value? So how will I multiply that or how will I compute that? Right? So I'm going to say this is as good as reinvesting the cash flow and getting that cash flow at the end of 2 more years, because I'm going to be earning how much? I'm expected to earn 9%, right? So I need to add at the rate of 9% for those 2 years. Are you with me? So I'm not taking out this particular cash flow over here. I'm not taking this cash flow out over here. Instead, I am going to take this cash flow when I'm going to take this cash flow after 2 years. Are you with me? So how much will be the cash flow at the end of 3 years? That is what we need to identify. So this 4.47909, which is the cash flow available at the end of the 1 year, is going to be reinvested and you are going to generate at the rate of 9%. So remember, if I'm going to invest 100 at the end of 2 years, this is going to be compounding rate where you are going to earn 9% for 2 years on this 4.47909. Similarly, for 6.53162, you will reinvest this and you are going to earn interest for 1 more year. Now, end of year 1, year 2, and you will reach to end of year 3. So there it will be only for 1 particular year. For the end of year 3 cash flows, there is no further reinvested required. Are you with me?
Yes, sir.
Is that clear?
Yes, sir.
Okay. So in that case, for 4.47909, when it is reinvested, right, it is going to be reinvested for how many more years?
2 more years.
For 2 years, right? For 2 years, because this is at the end of 1 year. So I'm going to reinvest this cash flows for 2 more years. As far as 6.53 is concerned, this is going to be reinvested for how many years? 1 year. And then here you will have 0 year. Why? Because we are essentially computing at the end of year 3 itself. Okay. So here I'm going to take future value factor at the rate of 9%. Now it's very important that you pay attention over here. We are not going to take over here the rates which are prevailing as per this year, but how much are the number of years for which you are investing, right? So here you can see at the end of year 1, what is the future value given to you? 1.188. So I'm going to take 1.188. Now, if you have any doubts, try to understand this. I am going to invest this amount, right? So say, for example, pay attention, please. I am investing 4.47909 into 1.09, right? Into 1.09, because I need to essentially invest for 2 years and this is going to be a compounded rate, right? So there is going to be 1.09 square. Am I right? So if you take 1.09 raised to 2. Or in other words, 1.09 into 1.09, what you will get is 1.188. And that is what is being provided to us. So the future value is given at the end of year 1. If you are reinvesting the cash flows, you will have 1.188. You can see over here, it is given in the reverse order, right? So you are given over here 2 years, 1 year, and 0 year. 0 year meaning, obviously, you will have cash flow at the rate of 1, right? So 1.090 and last one is 1. Okay. So what is my cash flow at the end of 3 years? That is 4.47 into 1.188. Similarly, I will multiply 6.53162 into 1.09 and 7.09 will remain as it is. So what is going to be my total cash flows over here? 19.5332. Is everyone getting the cash flow, total cash flow? Right? So this is my terminal cash flow, right? This is considered as my terminal cash flow. So how do you calculate your modified IRR? Modified IRR is going to be terminal cash flow. How do I calculate modified IRR? It's going to be, so how do I go about calculating this? Modified IRR is equal to square root of, right? It is going to be my terminal cash flow. Remember, I'm talking about inflows over here. Upon what was the outflow over here? Outflow was 15.625. Am I right? Okay. Now, this is supposed to be a square root if it is 2 years. But if it is more than 2 years, then what do? It will be 3 years over here. So it will be cube root of TCF upon 15.625. Right? So normally when you write this particular formula, it is basically nothing but TCF upon your cash flow, right? It will be raised to nth root, right? It is nth root of TCF upon your cash outflows. Okay. Now here, what will be my answer over here? I need to calculate over here. Can you calculate what is the cube root? Yes. So I want 19.5332 divided by 15.625. I want cube root of that. So since I am in Excel, I am going to say raised to 1 by 3. Now your normal calculators may not have the cube root function, right? So in that case, yes, sir.
Here I would like to supplement in case in such a situation, students are supposed to not to proceed further because from the ordinary calculators this cannot be calculated.
Are you allowed scientific calculators, sir?
No, not at all. We are not allowed at all.
Achha, okay.
Only ordinary calculator is allowed in the examination. So that's why we can leave the calculation here as it is. Don't worry about the same. There will be no deduction mark up till if the till this point if the calculation is correct, there will be awarded full marks.
Okay.
Because anything cannot be calculated from the ordinary calculator, that is not considered as a wrong answer.
Okay. All right.
Okay.
So as
Don't
we
worry,
have been
student.
already been
Please you
informed by
leave the
sir.
student just for the understanding. You can understand here.
Yes.
Okay. Otherwise, in the exam, don't worry about the same.
Okay.
Okay.
So that means my modified IRR is 7.725%. Right? Has everyone got that? So in this question, we were asked two things: calculate the NPV, which we have done already. There is a negative NPV. Remember, we were not asked to comment over here. That is the reason we have not commented or given any advisory over here. Normally, they do ask in the question that what is your decision. In that case, based on negative NPV, we would have said that it is not recommended, right? Since NPV is negative. However, here that is not being asked, so we have not commented upon it. We were asked to calculate modified IRR, so we have done that, right? Now we go to question number 5, which is very similar to what we did in question 7. However, there is one change, and that one change essentially makes the question very, very interesting. Just one word, which is very, very interesting. Okay, that is the reason I started first with question 7 before we go to question number 5 again. Has everyone got this? Right?
Yes.
All right. Let's go further to question number 5. Before I start reading out question number 5, again, a short reminder. In this particular case, first of all, we were given the nominal cash flows, right? We were given nominal cash flows, which means there was no inflation adjustment. And thus, we directly use the forex to identify the cash flows into the home currency, which is INR over here. And then we added the INR cash flow to it to get the total cash flow and further proceeded. Now, there is one change in question number 5. So how is that going to essentially have an impact on our computation? That is what is interesting to note. Okay. Let's start question number 5. XY Limited is engaged in large retail business in India. It is contemplating for expansion into a country of Africa by acquiring a group of stores having the same line of operation as that of India. The exchange rate for the currency of the proposed African country is extremely volatile. The rate of inflation is presently 40% a year. Inflation in India is currently 10% a year. Management of XY Limited expects these rates likely to continue for the foreseeable future. Estimated cash flows, projected cash flows in real terms, right? These two words has a huge implication. How so? We will see that in the solution, right? In real terms, in India as well as African country, for the first 3 years of the project are as follows. So we are given year 0, year 1, 2, 3. Cash flows in Indian rupees are in thousands, rupees in thousands. Same goes for rands in thousands. This is a South African currency, right? Rands, African rands. So here, remember, in the amount, you will have to mention amount in thousands. All right, fair enough. Now, we are given cash outflow and inflow respectively. XY Limited assumes that year 3 nominal cash flows will continue to be earned each year indefinitely. So when we talk about year 3 cash flows being earned indefinitely, so remember we had constant growth formula which we have learned even with your dividend, right? Constant growth flows. So we are going to use the same concept over here to determine what will be my constant growth formulas, because this amount is going to be there indefinitely. So at the end of the year 3, I will have one more cash flow to be added over here, and that is going to be the nominal value of the cash flows, which is going to remain indefinitely for the years to come. So I'm going to capitalize that value and add it in the year 3. It evaluates all investments using nominal cash flows, and a nominal discount rate. The present exchange rate is African rand 6 to 1. You are required to calculate the NPV of the proposed investment considering the following. African rand cash flows are converted into rupees and discounted at a risk-adjusted rate. So in the previous question, if you recall, your Nepali currency was converted to INR and then was subjected to discounted rate. So that way it is very similar. But there is one change. And what is that one change? All the numbers over here are given to you nominal cash flows at a nominal discount rate, but the original numbers are given to you in real terms. So first of all, you will have to convert your real term values into nominal cash flows, and then from nominal cash flows, that is from nominal cash flows of African rand, we will convert that into INR, and then the same process as we had done in the previous question. So these are the two words which has essentially changed the entire concept over here, how you need to go about solving this particular question. All cash flows for these projects will be discounted at a rate of 20% to reflect its high risk. Ignore taxation. We are given the PV factors at 20% for the 3 years. Okay. Now, let's start. First of all, I'm going to start with year. So I know for a fact I'm going to start over here with year 0, 1, 2, and 3. Right? All right. Now, again, remember the concept again. If you want, you can revisit the question to read it again. We are given cash flows in real terms. Real terms meaning inflation effect is removed completely. It is given to you at the year 0 rate, right? Now, if you are going to do inflation adjustment, that is, it is not nominal cash flows. And if I have to then in that case discount it, it won't be possible, right? So those cash flows are not going to take into account even the, I want to convert that into INR terms, my forex rates, remember, are going to be based on my respective inflation rates, which will not be possible. And thus, first and foremost, I take these real term values, convert them into the nominal values, only then can I start with the computations. Is that clear? Okay. All right. So first of all, I am going to break the parts into multiple parts. So say, for example, I'm going to say over here, I want cash flow. This is my real cash flow, right? Let me grab text. I hope this will be better visible as such, right? This is cash flow, the real cash flow. So that is, we are talking about African rands. Okay. To convert the real values into nominal cash flow, I will need to convert them at the inflation rates, right? So how do I do that? I will obviously have to incorporate over here inflation. And then I'll get cash flow, which is nominal cash flow, right? So first of all, what I have done is I've got AR, which is the real cash flows, African rands, and then I'm going to have African rands nominal cash flow. Okay, I'm focusing right now on one currency at a time, which is African rands. Coming back to the question, what is the cash flows given to us? In African rand, we are given question. It is minus 200,000, 50,000, 70,000, and 90,000. Now remember, this is a real value. So after inflation being effective, made effective, these numbers will actually increase or decrease. Yes?
Yes, sir.
Nominal cash flow should be higher than real flows or lesser than it.
Higher, sir.
Yes?
Higher value.
Exactly. It will have to be higher, right? So at the beginning of the year, there is obviously 1. But at the end of the year 1, what is the inflation rate which is prevailing in African country? We are given that is, inflation is presently 40% a year, right? So at the end of first year, what was normally available to you at 1 rupee, now you will have to pay 1.4 times of that. So it becomes 1.4 rupee. Similarly, or rather African rand, similarly, something that was available to you at 1.4 at the end of year 1, you will have to pay another 40% inflation on it. So that becomes 1.96. And again, what was available to you at the end of year 2 at 1.96 Rand, you will have to pay now again 40% more to buy the same thing, right? So this is the inflation effect. What we are doing is basically multiplying it with 1 plus 40%, which is inflation rate. So it is into 1.4, right? Now I have got the inflation, right? Inflation values being incorporated over here. So I can now convert my real value into nominal value. So far, so good, everyone.
Yes, sir.
Right? Now that I have got the nominal cash flow, I have got the nominal cash flows over here. Just like in the previous question, once we have the nominal cash flows over here, remember the previous question? Once we have the nominal cash flow available, then I can use the forex rate to convert that into INR cash flow and then add INR cash flow into it. Right? So here also, I have already got the nominal cash flow over here. This is inflation of African rand, right? So now I am going to convert this nominal cash flow into INR, and for that I am going to calculate over here forex rates. Now forex rates are expressed as African rand upon INR. Am I right? How do I know this? Check out the question. You are told over here, what is the African rand? African rand 6 to 1, right? So it is 6 upon 1. So this is African rand is 6. Let me take it till 3 decimal points. How do I calculate over here? Should I use IRP or should I use PPP? You don't have interest rates over here. What you are given is inflation rates, right? So I will use purchase power parity to calculate what will be my forex rates for year 1, 2, and 3, which is known as expected forex rates, right? Expected spot rates. All right. So 6 into, now remember in the numerator you have AR. So I have to take inflation rate of AR first in the numerator into 1.4 divided by, what is the inflation rate in India? What is the inflation rate in India? Is it
10%.
20%? 10%? What is it?
10.
10%. Here it is given to you in the second line. 10%, right? So divide by 1.1. Right? So you have to, again, 7.636 into 1.4 upon 1.1. So you will get 9.719. Right? Similarly, for the last year, you will again say 9.719 into 1.4 upon 1.1. So I get my forex rates for the 3 years at the end of year 1, 2, and 3 respectively. Got it, everyone?
Yes, sir.
Okay. Now, I have to convert this into AR to INR, right? So what is going to be my cash flow? How do I do this? Should I multiply or should I divide?
Divide down the ladder.
Down the ladder. Up the ladder, multiply. Down the ladder, divide. Right? I am going from AR to INR, so I am going down from numerator to denominator. So it is going to be divide. So 2 lakhs divided by 6. Right? And I'll get the same thing over here. This is my African cash flow, which is now being converted into INR cash flow. African cash flow is converted into INR cash flow. Okay, but this is, remember, now AR to INR, this is nominal cash flow, right? Which we already converted for AR nominal to INR. Now what I'm going to do over here is I'm going to just mention the column numbers for your easy reference. This is column number 1. Okay. These are basically column numbers, okay? Just for easy reference. So column number 2, then you had column number 3, then you got column number 4, which was, how did you get column number 4? We multiplied 2 into 3, am I right? Then I had column number 5, then we got column number 6, which was equal to, how did we get this? Column number 4 divided by column number 5. Okay, so I have found now AIR to INR converted cash flow. Remember, this is a nominal cash flow. Okay, this is nominal cash flow of AR to INR. So I can use this for computation. I need over here now INR nominal cash flow. But what is being provided to me is INR real cash flow, right? So how do I convert that? How do I do that? I will have to take INR. Real value is given to me. So I'm going to calculate over here. Cash flow real, right? Yes, cash flow real. What is my cash flow in INR terms given to me? Let's look at the question again. Cash flows in Indian rupees in thousands. 50,000 minus 1,500 minus 2,000 minus 2,500. So all cash flows are negative. Minus 50,000. Then you have minus 1,500. Minus 2,000 and minus 2,500. These are my INR real cash flows. I need to calculate now what will be my INR nominal cash flows. How do I do that? How do I do that? Yes.
Divide by inflation rate.
Yes, I will need to incorporate the effect of inflation, but not divide, right? It is going to be the real value, my dear. So I will have to essentially multiply it, right? The concept still remains the same.
Sir, multiply it.
Okay. So at the beginning of the first year, it is 1, right? Then I'm going to incorporate now what was worth 1 rupee at the beginning of the first year. For getting the same thing, now I need to spend 10% more, right? So it will become 1 into 1.10. because I need to spend 10% more to get the same thing. That is inflation. Then at the end of year 1, I was getting it for 1.1, but now again I need to spend into 1.1 into 1.1. So my inflation values are 1, 1.1, 1.21 and 1.331. Right? So what will be my cash flow nominal in INR terms? It will be cash flow real multiplied by inflation INR, right? This is column number 7, column number 8, column number 9 is nothing but 9 is 7 into 8. So I have my INR nominal cash flow available. So my India-based nominal cash flow is this particular column, right? And then my African cash flows, which were converted into nominal cash flow over here, was this one. So now I need to get my total cash flow, right? So total cash flow. How much will be my total cash flow now? It will be column number 10 is equal to what? Column number 6 plus column number 9, right? So this plus minus 50,000. Same thing I need to repeat for the 3 years. So the total I will have is minus 47,482. Are you all with me? So we have done major part. However, there is one important aspect which is still remaining. These are my nominal cash flows. So now what I need to do is I need to subject that to the discounting. PV factor at what percentage? What is the discounting rate for me? 20%, am I right?
Yes, sir.
Discounting rate is 20%, am I right? Okay, it's already given to you to reflect its high risk. So I have PV factors over here. At the beginning of the year, it will be 1, and thereafter it is 0.833. Then you have 0.579, and then 0.694 and 0.579. So now I'm going to have present value. of cash flow, right? Present value of cash flow. Is 10 into 11. Okay. So I'm going to multiply the nominal cash flows with the respective PV factors. And then I'm going to do the total. So my total is coming to, this is my NPV. NPV is negative 59,321. Now, one more important thing, as I had mentioned in the previous question, amounts are in thousands.
Thousands.
Please do not forget that. So my NPV after 3 years is minus 59,321. But there is one very important adjustment which is not being factored in, and that is we are given the information over here. XY Limited. Here you see what we are told over here is XY Limited assumes the year 3 nominal cash flows will continue to be earned each year indefinitely. Will continue to be earned each year indefinitely. So here my constant growth formula will come into picture. How will I essentially use that? How do we normally calculate using constant growth formula? Do you remember? Yes, anyone? We used to normally use this formula, if you recall. You recall this?
Yes, sir.
Sorry. Here it is P0, right? P1 upon P0 plus G. Now that I have to find actually P0 over here. So how will I do that? This will become KE plus minus. This was plus G. So now it becomes
Minus.
minus on the other side. This is D1 upon P0. Now I want P0 on the left hand side. So I will take P0 over here. That is D1 upon KE minus G. Right? So here I am told the expected earnings which I am expecting is the nominal cash flows of year 3. Do you have the amount of year 3 nominal cash flows? Do we have that? Check over here. Do we have the nominal cash flow of year 3? We have the nominal cash flow of year 3.
So
Yes. What is the nominal cash flow of my year 3?
16,637.5.
This is my total nominal cash flow, right? 16,637.50. And you are expecting this to be there at the end of next year as well. This is end of 3 years. And you are expecting this will continue indefinitely. So 16,637.50. This is your expected earnings for the next year. Right? What is my KE? What is my discounting factor over here? Required rate of return?
8%.
0.20. Am I right?
Yes, sir.
Now 20 minus G. KE minus G, isn't it? But do you have any growth rate over here? What are they telling you? This will remain same indefinitely, am I right?
Yes, sir.
So growth rate is 0. So what will this value turn into? 16637.50 divided by 0.20. That is for all the future cash flows, right? And the value is determined as at the end of year 3. So I will have to multiply this with which PV factor now? Because this is to be brought at current value, right? This is at end of year 3. Am I right? At end of year 3, I am saying 1637 for next year also. What is going to be your earnings for the next year? 16637.50, right? So I am getting this value. Say for example, this is coming to 20,000. Just hypothetically, yeah, please pay attention. So say for example, this is 20,000 at the end of year 3. But this is at the end of year 3. I need to bring it to today's value, right? So I will multiply this with which PV factor? At the end of year 1, 2 or 3? Which one I will use? It will be
End of year 3.
end of year 3, yes, 0.579. Now this value is obviously not 20,000. This value will come as 16637.50 divided by 0.20. So that comes to how much?
83,187.5.
83,187.5, right? Into 0.579. So that will give you maybe 40,000 or something. What is that amount?
48,165.5625.
48,165.5625.
5625.
Okay. Now remember, this is positive cash flow. Okay, this is a positive cash flow as this was 16,637 positive. So this is a positive cash flow. Okay, 48,165. This is called terminal cash flow at constant growth rate. Right. So now, what is the total NPV coming to? So NPV will be equal to minus 59,321.35 plus 48,165.5625. So this amount will be how much? Yes. So what is the total NPV? Anyone?
Minus 11155.7875.
555.7875.
7875.
Okay. So my total NPV is coming negative 11,155.7875. In the question, you are required to calculate the NPV of the proposed investment considering the following. African rand cash flows are converted into rupees and discounted at risk-adjusted rate. We have done that. All cash flows for these projects will be discounted at a rate of 20% to reflect its high risk. Ignore taxation. Again, over here, they have not asked us any recommendation. So if I don't give a recommendation, I'm completely okay. But say, for example, if that was asked in the question, then in that case, would we say it is recommended to accept this project or to reject this project?
Not accepted, sir.
We will not accept it, right? Because it has negative NPV.
Negative
So we
NPV.
will recommend or suggest that it should be not accepted or it should be rejected as it has negative cash flows. That is NPV, right?
Yes, sir.
Is that clear to everyone?
Yes, sir.
All right. Shall we move further now? All right. Now let's move to the next question. Next question we are going to do is question number 6. Question number 6. It is question number 6. All right. We start over here, question number 6. A multinational company is planning to set up a subsidiary company in India where hitherto it was exporting in view of growing demand for its product and competition from other MNCs. The initial project cost consisting of plant and machinery, including installation, is estimated to be $500 million. Net working capital requirements are estimated at $50 million. The company follows straight line method of depreciation. Presently, the company is exporting 2 million units every year at a unit price of $80. Its variable cost per unit being $40. The CFO has estimated following operating cost and other data in respect of proposed project. Variable operating cost will be $20 per unit of production. Additional cash fixed cost will be $30 million per annum, and project share of allocated fixed cost will be $3 million per annum based on principle of ability to share. Production capacity of the proposed project in India will be 5 million units. Expected useful life of the proposed plant is 5 years with no salvage value. Existing working capital investment for production and sale of 2 million units through exports was $15 million. Export of the product in the coming year will decrease to 1.5 million units in case the company does not open subsidiary company in India, in view of the presence of competing MNCs that are in the process of setting up their subsidiaries in India. Applicable corporate income tax rate is 35% and required rate of return for such project is 12%. Assuming that there will be no variation in the exchange rate of two currencies and all profits will be repatriated as there will be no withholding tax, estimate NPV of the proposed project in India. PV interest factors for 5 years are as follows at the rate of 12%, that being your required rate of return. So discounting factor is 12%. Okay. All right. Now, first and foremost, what is happening in this particular question? Let us understand. You have a particular, you are already manufacturing and exporting, right? So you are currently exporting how much? You are currently exporting 2 million units, right? Which is expected to reduce to 1.5 million units if you don't come out with a subsidiary. If you come out with a subsidiary, then the subsidiary is going to have a production capacity. Subsidiary, this is the new project. Then the production capacity will be 5 million units of this production facility, which will be in India, right? Now, for this, how much is the investment? Your investment is going to be how much? Investment is 500 million plus. Do you have any net working capital requirement over here? Additional investment for working capital? Yes. What is being told to us?
$50 million.
Yes. You have a requirement for another $50 million, right? So you have 50 million requirement for working capital, right? However, we are also further told, if you look at point number 5, existing working capital investment for production and sale of 2 million units through exports was $15 million. So if you are going to essentially manufacture it over here, right, then in that case, you would not be obviously manufacturing it over here and trying to sell it to India. This will essentially get replaced, right? So that means the 15 million, which was the working capital required in my existing business, will get freed up. So how much incremental investment will have to be done on working capital? 50 minus 15. Are you with me? Yes? Yes? Hello? All right. So,
Excuse me, sir.
yes.
सर इट मीन्स जो सब्सिडियरी है उसमें 5 मिलियन का प्रोडक्शन हो रहा है, इसकी वजह से हम और जो यानी जो 15 मिलियन का प्रोडक्शन है वो फॉरेन कंट्री में ही हो रहा है, इसीलिए हमने यहाँ 15 मिलियन माइनस किया.
See, you are currently, say for example, in US.
Yes, sir.
You are manufacturing over here and
Hmm.
transferring to INR. You are selling in INR in India,
Yes, sir. Yes, sir.
right? You are selling how many units? 2 million units.
2 million.
Now you are already going to set up. If you set up the subsidiary over here, then you will be manufacturing over here 5 million.
5 million.
Remember, your demand itself is 2 million
2
currently.
million.
So why would you then in that case manufacture over here and send it over here? Because then transportation cost and everything else will also come into being, right?
Yes, sir.
So you essentially get saved all that because you were expecting that this 2 million, if you don't start with this subsidiary, any which ways your 2 million units will become 1.5 million units because of new competition which is coming in India.
Okay.
Okay. So here, if you are going to have a production facility in India, obviously you will not be requiring this exports. Maybe you may continue to have that business and probably export somewhere else, but definitely not for India, right? So
Yes,
this
sir.
15 million, which was your investment for this India business, is going to get released.
Yes, sir. Yes, sir.
So what is my incremental business cash flow which is required over here? 500 million plus 15 minus 15, because this 15 million will be released. So I will have to essentially put additional how much? 35.
35. Yes, sir. Clear.
Getting it?
Yes, sir. Thank you, sir.
Yeah. All right. And then we will need to calculate what is the cash flow after tax. So we will have to, since we are given the details about what is the sale price, what is the variable cost, right? Variable cost is given to you, fixed cost is given to us, right? And then production capacity is also given to us. So we are going to calculate over here the cash flow after tax, right, for those 5 years. Now, nothing is mentioned about there is differential values. So obviously, your cash flow is remaining static for the 5 years. Are you with me? And as far as depreciation is concerned, you are told depreciation is straight line method of depreciation and there is no salvage value, right? So whatever is your investment in plant and machinery, how much is my investment in plant and machinery? 500 million, right? Minus salvage value is 0. Divided by life in number of years, so that is 5. So how much will be my depreciation per year? 100 million. Are you all with me?
Yes, sir.
Okay. All right. Now let's start solving this sum. Okay. Let's start solving this sum. From here. Okay. So first and foremost, we are going to start with how much will be my cash outflow on this, or cash outlay as we normally call it. Okay. So first I am going to start with this cash outlay for the subsidiary company. Right? How much will that be? So I have to put in initial project cost. This is consisting of plant and machinery, right? Plant and machinery and its installation. So how much is that? US dollar. It is dollar in millions, right? 500. To that I will say add net working capital required. How much is that? 50. Okay. And then I will say less working capital released, right, from existing. How much is that? 15. So 500 plus 50 from 550 minus 15. This is my net cash outlay, right? Second is computation of cash flow after tax. So how do I go about computing my cash flow after tax? What is the information given to me? First is going to be my revenue. What is going to be my revenue? I am told I will be selling 5 million units, right? Production will be 5 million units and my unit price is $80. So 5 million units into $80. That is 5 into 80. $400 million is my revenue. This cost. What is going to be my variable cost now? When I'm manufacturing in US, my variable cost is $40 per unit. But when I'm manufacturing in India, your CFO is estimated operating cost will be how much? Variable operating cost will be $20. Operating cost will be how much? $20 into 5 million, right? So I get E into 5. So I get 100 million units. Value, dollars, $100 million. $20 into 5 million, that gives you $100 million. Further, you also have fixed cost. That is US dollar 30 million. This is already given to you. This is the given information, right? Further, now you are told project's share of allocated fixed cost will be US dollar 3 million per annum based on ability to share, based on principle of ability to share. So is it really the direct cost as of now? That's only apportionment, right? This is only the apportionment and not the actual cost of my Indian unit. So I am not going to factor that in as of this particular moment, right? So I am going to say this is the cost. Any other cost which is there? Expected useful life of the project is 5 years. So, oh yes, depreciation. I have to calculate depreciation. How much will be depreciation? 500. Mind you, there is no salvage value, so divide by 5 years. So 500 divided by 5 years. So I get 100 million as my depreciation. So no other cost being there. So I'll calculate over here what is going to be my earning before interest and tax. Is there any interest given over here? Any information on interest? No. So this is also my EBT, earning before tax. Right? Then I will say less tax. How much is my tax? Tax rate is given to you in the question. Yes, tax rate is given to you in the question.
35%.
35%. Right? If you see information 7. Information 7. Right? Okay. So what is my earning before tax to start with, first of all? So it is 400 minus 100 minus 30 minus 100. So I get 170, which is my earning before tax. Tax is 170 into 35%. So that comes to 59.5. And then I get EAT, earning after tax, which is 170 minus 59.5. So I get 110.5 as my earning after tax. What is my objective over here? My objective over here is to find cash flow after tax. Is this the cash flow after tax, or do I need to make some adjustment to it?
Add depreciation.
Yes, add depreciation back, right? It's a non-cash cost. Add depreciation. So that is 100. So I get CFAT, which is 210.5. Now this is cash flow after tax for how many years? For 1 to 5 years, right? Constant, no change. Nothing else is mentioned, so I'm assuming this is the same for all the 5 years. Cash flow after tax of 210.5. Further, at the end of the 5th year, do you have any other cash flows which are going to happen? What are the normal cash flows which may happen at the end of the project? cash flows at the end of 5 years. Which could that be? There are only two things which generally happen. One is net working capital released. Second one is salvage, right? Do you have any net working capital released? How much was net working capital which you had invested? Yes, how much net working capital you had invested? 50 minus 15, right?
Yes, sir.
So that 35 million will get released. Do you have any salvage of the machineries? You are told anything about the salvage value? Will there be any salvage value? There will be no salvage value,
No
right?
salvage value.
Salvage is 0. So this is going to be 35. Further, do you have any opportunity cost over here? You were generating some cash already by exports, right? So if you don't do this business, if you don't open this, it's not like you will not have any business at all. You will have some business. So you are already making some income. Am I right?
Yes, sir.
What are the income you are making already or expected to make?
Sir, export will decrease to 1.5 million if the
Exactly. Very good. Very good. So whatever you are going to earn from that 1.5 million units, now that will not come.
yes,
That
sir.
becomes your opportunity cost.
Yes, sir.
Okay. So opportunity cost of on export earnings, right? Because now that earnings will not come. You are getting the earnings over here. So obviously that earnings will not come. So now again I have to calculate over here what is my revenue in 1.5 million units. So 1.5 million units into $80. Am I right? This would have been my sales. 1.5 into 80. Obviously, this entire revenue was not my income. I was making some expenses also, right? So what were my costs? $1.5 million units into $40. कहाँ पे दिया है ये? Where is it being mentioned in the question? You can see over here, it is being mentioned over here. Can you see my cursor over here, everyone?
Yes, sir.
Right? So that is 1.5 into 40. So now I am left with 120 minus 60. Right? Now there is no information being mentioned about any fixed cost. Right? So I am going to say this is my contribution. Right? From that, I have to say less tax. How much will be tax? 35%. So 60 into 0.35. 21 is my tax. So what is my cash flow after tax? What is my cash flow after tax? Yes. minus 21. So I will have $39 million in cash flow had I not essentially pursued this. If I choose not to pursue this project, then I'll have $39 million year on year, right? For the next 5 years. So this is for all the 5 years together. Are you all with me?
Yes, sir.
So what is the incremental cash flow which is coming out of this particular project? So how much is the incremental cash flow? Incremental cash flow from subsidiary. How much will that be?
210.5 minus 35 minus 30.
C control E, right? So here I will say first of all, no hold, no hold. Okay, all right. First of all, this is going to be 210.5 less CF80 1 to 5 years, right? From exports. This is my opportunity cost, right? That is 39. So net cash inflow or incremental cash inflow will be how much? 171.5. Now I need to calculate the NPV. Shall we start with computation of NPV? NPV. I am going to have 1 to 5 years. So there are or year 1 to 5, you have certain cash flows, right? This is CF80 going to on 171.5 every year, right? So I have two options. Either I can keep multiplying 171.5 individually with each of the years, or since 171.5 is common, so what I'm going to do is instead of taking,
Factor.
yes, so instead of taking individually, I will take the summation of all of them together, right, for 5 years. So I will need to obviously total this up. How much is this coming to?
3.6048.
Acha, you have done that, beta. Thank you. 3.6048.
6048.
3.6048. How do you get this 3.6048? It is basically summation of all these already PV factors which are already given to you, right? For the 5 years. This is just the annuity factor. When you add it, you get the total value. Okay. So I can just say multiply 171.5 into 3.6048. So you will have, this is your PV of cash flow. Is there something else also which is coming to you after 5 years? You already calculated that, remember? What is that? Net working capital which will be released, right?
Yes, 35.
So that will obviously be coming at the end of 5 years. So what is the applicable PV factor for that? 0.5674.
567.
So this is my total NPV, right? This is my total cash PVCI, present value of cash inflows. From that, I will say I need to subtract what? Cash outlay. What was the cash outlay or PVCO? Did we compute that? Have we computed that? In note 1, we had computed that.
535.
So that was note 1, right? 535. So minus 535. So 103.082. This is the NPV. Again, check, are you asked for any suggestion or recommendation? Are you asked to give any suggestion? Assuming that there will be no variation in the exchange rate of two currencies and all profits will be repatriated as there will be no withholding tax, estimate NPV of the proposed project in India. Are we asked for any recommendation?
No, sir.
Initial project cost, where company follows, present company is exporting 2 million every year, CFO is estimated, other data in respect of proposed project. So as such, in the question, there is nowhere they are asking, right, for us to recommend or give our suggestion. However, if you were to be asked, evaluate, if you are told evaluate, then what will you do? What will be your recommendation?
Accept the project as the NPV is positive.
Yes, exactly. So, and in the examination, if you ever feel that पूछा है नहीं पूछा है वापस question पढ़ना पड़ेगा. If you have to read the entire question through, it's always better since you have already computed. You may also give that suggestion, right? Because there will be no deduction of marks for it.
Yes, sir.
But if there is any marks allocated for it, at least it will not get deducted,
Yes, sir.
right? So you can always say accept the project. Like for example, I will say accept the project as NPV is positive. Okay. If it is negative, then we say reject the project as NPV is negative. Okay. So with that, we have completed question number 6. Today we have done so far 3 questions. Question number 7. Then we started with first we started with question number 7, then question number 5, and now we have completed question number 6. Next, we will start with question number 11. But before that, shall we take a 10-minute break? Shall we take a 10-minute break, please? Okay, sir. Thank you. All right, now we start with question number 11. The management of a multinational company, TL Limited, is engaged in construction of infrastructure project. A proposal to construct a toll road in Nepal is under consideration of the management. The following information is available. The initial investment will be in purchase of equipment costing USD 250 lakhs. The economic life of the equipment is 10 years. The depreciation on the equipment will be charged on straight line method. EBITDA to be collected from the toll road is projected to be USD 33 lakhs per annum for a period of 20 years. So again, there is a constant value which we are expecting. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakhs at an interest rate of 6% per annum. The interest is to be paid annually. The loan will be repaid at the end of 15 years in one tranche. The required rate of return for the project under all equity finance is 12% per annum. Post-tax cost of debt is 5.6% per annum. Corporate tax rate is 30%. All cash flows will be in USD. You are told ignore inflation. You are required to advise the management on the viability of the proposal by using adjusted NPV method. All right. Now, before we proceed further, let's read this question once again. Following information is available. Initial investment will be in purchase of equipment costing USD 250 lakhs. Economic life of the equipment is 10 years. Depreciation will be charged on straight line method. Right? Now, when I talk about depreciation, what is my formula or method? OC minus salvage, right? Original value minus salvage upon life in years. So my cost is 250 lakhs minus. Do I have any salvage value over here? Upon 10 years. Yes. Do I have any salvage value over here? I have any salvage value? The answer is yes or no. No, there is nothing mentioned about the salvage value, right? No salvage value is there. So in that case, my salvage value is 0, which means my depreciation is going to be 25 lakhs per annum. Are you with me?
Yes.
Okay. EBITDA to be collected from the toll road is projected to be USD 33 lakhs per annum for a period of 20 years. To encourage investment, Nepalese government is offering a 15-year term loan. All right. So this is a separate part altogether. So there are two parts to it. One is your project, right? And second is the loan which is available to you from the Nepalese government, right? So these are two different things altogether. But both the opportunities are available. You can take the money from here and you can put in over here, right? So that is the reason when we calculate our adjusted NPV, we are going to look at the NPV from both these aspects and then obviously take the summation of the same. Okay, all right. Now, when we are talking about EBITDA, remember it is talking about for 20 years. So I can do the summation of whatever is my cash flow. This is EBITDA. I need cash flow after tax, right? So I'm going to calculate cash flow after tax and then I will essentially apply a 20-year summation How do I look at that? You can see over here, we are given present value, annuity factors are given to you at the rate of 12% for 10 years, at the rate of 12% for 20 years, right? So we will use this particular rates. Now the second one given is 8%. This is very, very important. Why do I say important? Because majority of the students tend to overlook that. Now this brings us to basically the loan part. Okay, so that is the reason we are reading this question again before proceeding with the solution. To encourage investment, Nepal's government is offering a 15-year term loan of USD 150 lakhs at interest rate of 6% per annum. The interest is to be paid annually. The loan will be repaid at the end of 15 years in one single tranche, meaning you are taking 150 upfront at year 0, that is beginning of the first year, and then you are going to pay 150 lakhs at the end of 15 years, right? Now, you are told over here, very important information, required rate of return under all equity finance is 12% per annum, right? And post-tax cost of debt is 5.6% per annum. Here there is a hidden adjustment. What is that hidden adjustment? It is post-tax cost of debt is 5.6% per annum. Now here you are told, if you will relate this and the next information, corporate tax rate is 30%. So in that case, can you please tell me what will be your pre-tax cost of debt? Yes, pre-tax cost of debt will be how much? 5.6% divided by 1 minus tax rate. Am I right? So that comes to 5.6% divided by 0.7 is equal to 8%. Right? So now you were told interest is 6%, but now here you are computing at 8%. What is the meaning of this? So the required rate of return for equity financing is 12%, but the required return for debt financing is how much? It is 8%. So when we evaluate the cash flows using the PV factor for the purpose of debt, the Nepalese government loan, PV factor will be 8% and not 6%. Is that clear to us? While when we compute over here, right, when we compute the cash flow after tax over here for EBITDA, etc., we'll consider it at 12% per annum. Is that clear to us?
Yes, sir.
Okay. All right. Now let's start the question. I am removing this because this was an easy part. I can start the solution for you. Okay. All right. So let's start. So first, I'm going to start with net present value, NPV. NPV of management of a multi is engaged in construction of infrastructure, proposal to construct a toll road. Okay, so NPV based on all equity financed. Okay, so this we are going to compute based on all equity finance first of all. Why? Because my required rate is 12% per annum. Okay, so let's start that. Particulars you are going to receive, obviously I will need to first of all calculate over here what is going to be my CFET, right? Because I am given EBITDA, so I need to calculate what will be my CFET period, because it is the same static period for a lot of the cases, right? For 10 years, for 20 years, so on and so forth. Then USD in lakhs, that is amounts in dollars. And I have PV factor at the rate of 12%. And that will give me PV cash flow, which is my ultimate objective. So are we ready first of all with this particular table being created? So first and foremost, I have initial investment. Initial investment is happening at the beginning of the first year itself. So period 0. How much is that? 250 lakhs. Then on this, I'm going to make beta of how much? 33. For how many years? 1 to
20 years.
for a period of 20 years. 1 to 20 years. Right. Now on that I will also have to pay tax, right? Tax is at what rate? 30%. Tax at 30%. One to 20 years. How much will that be? 33 into 0.3. So it will come to 9.9 lakhs. Now normally when we compute EBITDA, what do we do normally? This is only for your understanding purpose which I am writing over here. So normally what I do is I say EBITDA, right? From that I will say less depreciation, right? Then I will get EBIT. There is no interest over here, so I am going to say EBT also. Why no interest? Because I am assuming over here all equity finance, right? So then I have earning before tax. Then I say less tax. And what I get is EAT, which we did in the previous question also. Then I will again add depreciation. And that will give me CFAT. So the question over here is, I was supposed to subtract depreciation, right? And then I needed to calculate CFAT. So why am I not doing this? Sir, why are you not doing this? That should have been the question immediately. Now, remember over here, EBITDA is going to come to me for 20 years, right? On the other hand, depreciation is going to be there for how many years? Depreciation is for how many years?
10 years.
Only 10 years, right? So if you want to do it like this, then in that case, what you will need to do is, you will need to do 1 to 10 years separately, right? And then you will have to take 11 to 20 years separately. Are you with me? Because your depreciation will be 0.
Yes, sir.
So instead of having to compute this entire thing twice, what I have done is, I have taken EBITDA for 20 years, subtracted tax for 20 years, and then I'm going to take now depreciation for 20 years or 10 years now. Depreciation will be for 1 to 10 years, right? And then I will account for tax saving on depreciation, which will be for how many years? 1 to 10 years. Are you with me? You can follow either of the methods, right? So EBITDA is 33, for example, less depreciation is 25. So what remains is 33 minus 25. That becomes 8. Less tax is 30%. So this is 8 into 0.3. 8 minus 2.4. Right? So I get 5.6. Then I'm going to add depreciation back, which is 25. And my CFAT will be 5.6 plus 25. So 30.6. For the next 10 years, depreciation is going to be 0. So you will have a cash flow of 23.1 in the next 10 years. Are you with me? Okay, then you can multiply this with PV annuity factor. For 1 to 10 years, do you know PVT annuity factor? At the rate of 12% for 10 years is 5.650. So you can always multiply this with 5.650, right? And for the 20 years, kitna hai? You are not given 10 years, which is 11 to 20, but you are given what is for 20 years, 7.469, right? So I will say equal to 7.469 minus whatever was the annuity for the first 10 years. Okay, and then you get this into this, right? This is how you would have computed had you done it tabular form. This is PVCF. Are you with me, everyone?
Yes, sir.
Okay. So, and then I would have obviously, इसका total कितना होगा 214, right? So इसका total मैं करूँगा 214, and then I will say less initial capital cash outlay. कितना था cash outlay initial? 250. So I'll get 214 minus 250, negative 35.0911. Right? This is my NPV. In the examination, remember, you have to solve by only one method, okay? Either you do this one or the one which we are doing over here, okay? Either of them, whichever you think you are able to understand it better, okay? So you can do it that way, no problem whatsoever. Is that clear to everyone? So, ये वाला method हो गया. Now I am calculating it over here. 25, and then what was the tax saving on 25 into 0.3? So 7.5. Now I will just use the respective annuity factors. Initial investment ka annuity factor will be 1, right? EBITDA is for 20 years. So 20 years ka annuity factor kya hai? 7.469. 7.469. 7.469. Right? Depreciation is for 10 years. So uska kitna hai? 5.650. 5.650. Now let's do the multiplication of USD into PVF factor. यहाँ पे एक चीज मिसिंग है और वो है साइन, राइट? कैश आउटफ्लो है, so I'll put over here a negative sign, right? EBITDA is inflow, 9.9 is a tax, so that will be again outflow, right? Am I right? Yes or no? Similarly, depreciation is negative and tax saving is a positive number for me, right? So, chalo. FA 250, 446. ओके, यहाँ पे ऑलरेडी हमने ये बना नहीं आएगा फिर, बिकॉज वी आर अकाउंटिंग डायरेक्टली फॉर ओनली टैक्स सेविंग. ये एबिटा नंबर है ना, so I don't have to add back depreciation. Okay, so same again, NPV दोनों मेथड से आपका एनपीवी सेम ही आ रहा है. कैन यू सी दैट? राइट?
Yes, sir.
You can have either of the approach, whichever you think makes best sense for you. You can follow that particular approach. अगर आपको लग रहा है यहाँ पे सर ये एक मिस हो गया वगैरह, so then in that case you can always go by this particular method. Not a problem. Okay. So this is the first part. Like we have done so far NPV of all equity finance. Now, if we take a loan, right, then that is my second part. So I need to analyze that part as well, right? So now I'm going to calculate PV of financing by debt. So how do I go about that? अब यहाँ पे when I take a loan, you again start. Okay, so I'm going to again take this particular Control C, Control V. I'm going to make some changes over here, right? Okay, first of all, PV factor कौन सा रहेगा? PV factor
8%.
8%. ये 8% कैसे मिला मुझे?
क्योंकि ये डेट वो लोन इन्वेस्टमेंट.
Yes, we are told over here.
टैक्स.
Language used in the question. Here we are told post-tax cost of debt, right?
Yes, sir.
Tax cost of debt is 5.6%, right? Tax rate 30%. So pre-tax debt will be how much? It will be 5.6 divided by 1 minus 30%, right? So I get 0.08 or percentage terms 8%. This becomes my required rate of return for debt financing, right? Okay. So now we start computing. First is loan. Loan will be at the beginning of the year. How much USD lakhs? 150. Then I will have to pay interest on this loan, right? Interest I will have to pay for how many years? Because entire amount is going to be paid after 15 years, remember? So I'll have to pay for how many years? 1 to 15 years, right? How much interest will I pay? 150 into 6%. Are you with me?
Yes, sir.
ये तो मैं यहाँ पे लिख देता हूँ interest at 6%. Remember, it is the loan. Nepalese government is giving you a loan at 6%. Please do not get confused between the 6% and 8%. The 6% is the rate of interest which Nepali government is charging you on the loan. 8% is the required rate of return for your client over here, right? What's the name of the client over here? TL Limited, right? So TL Limited has this required rate of return from loan. All right. Next is I'm going to have tax saving on interest, right? That will be also there for how many years? 15 years. How much is that going to be? 9 into 0.3, which is 2.7 USD lakhs every year. And then I have to repay the loan, right? Repayment loan. Remember, I have to pay this loan in one tranche, that is at the end of 15th year, right? 150, I'm going to repay. Now, since it is a repayment, I will say it is minus, right? Okay. Similarly, interest is negative, am I right? And tax saving is going to be a positive phenomenon for me. Are you with me? These are the only things which are happening as far as the loan is concerned. Now, PV factor at the rate of 8% for the loan at the beginning of the year will always be 1. For 1 to 15 years, you are given the rate over here 8.559. Can you see that? At
Yes,
the bottom of the screen over here in the corner,
yes, sir.
this is the 8.559. Same goes for, again, interest also, or rather tax saving on interest, right? And then repayment of loan is going to happen at the end of the 15th year. So that one is 0.315. Now, for present value of cash flows, multiply the value into PVF factors, right? These are the cash flows into PV factor. So I'm getting 48.8283 positive. What am I asked in the question? I was asked in the question, you are required to advise the management on the viability of the proposal by using adjusted net present value method. So I'm going to calculate adjusted net present value method, and then I'm going to advise. So what is the adjusted net present value method? Right. So NPV from all equity financed, right, plus NPV from debt, right? So how much is that? Equal to, here I have minus 35.0911 plus 48.8283. So I'll have a NPV of 13.7372. What is this? By the way, these values were in lakhs, right? USD lakhs. So USD lakhs. Okay. All right. Now, what should be my recommendation? What should be my recommendation? Should we accept the project or reject the project? Is NPV positive or negative?
Accept the project.
NPV is that is
Positive.
adjusted present value. Since adjusted PV is positive, so PL Limited is advised to accept the project. Okay.
Yes, sir.
This is your question number 11 from the assignment. Now we go to the next one. Question number 9. Are we all through with this? Question number, previous question 11. Okay. Then next is question number 9. Okay. Question number 9. A US company wants to set up a manufacturing plant in India, which requires an initial outlay of rupees 8 million. It is expected to have a useful life of 5 years with a salvage of rupees 2 million. The company follows straight line method of depreciation. To support additional level of activity, investment would require one-time additional working capital of rupees 1 million. Since the cost of production is lower in India, the variable cost of production would be rupees 30 per unit. Additional fixed cost per annum is estimated at rupees 0.5 million. Company is projecting its annual sales to 80,000 units at the price of rupees 100 per unit. Applicable tax rate to the company is 34% and its cost of capital is 8%. Inflation rates in US and India are expected to be 8% and 9% respectively. The current exchange rate is rupees 72 per US dollar. Assuming that all profit will be repatriated every year, meaning whatever profits are there will be taken out on a yearly basis, right? So that is not going to get reinvested. And there will be no withholding taxes. Estimate the NPV of the proposed project in India and evaluate its feasibility. PVF at 8% for 5 years are as under. Okay, all right. So, first and foremost, what is question talking about? There is a initial outlay of rupees 8 million, right? So, initial cash outlay 8 million. Useful life of 5 years with a salvage of 2 million. So, how much will be depreciation? Yes. 8 is original cost, minus 2 is the salvage value upon number of years.
1.2.
Am I right?
Yes, sir.
So it will be 6 upon 5, 1.2 million. All right. Support additional level of activity, investment would require one-time additional working capital of 1 million. So that will be added over here, one-time additional capital of 1 million. Since the cost of production lower in India, variable cost of the project would be 30 per unit. Additional fixed cost per annum is rupees 0.5 million. Company is projecting its annual sales to 80,000 units and a price of 100 per unit. Applicable tax rate is 34% and cost of capital is 8%. Cost of capital is your required rate of return, right? Discounting factor. Required rate of return. Okay. Inflation rates in US and India are expected to be 8% and 9% respectively. In current exchange rate is rupees 72 per US dollar. So remember here, we will need to do some adjustment and find the expected spot rates. Why do we need to find expected spot rates? That is mainly because profit will be repatriated every year and there will be no withholding taxes. Okay. Since profit is repatriated every year, I would obviously need what is going to be the forex rates at the end of the year. So that I will use obviously over here using inflation rates. So I will use PPP to calculate my forward rates. Estimate NPV of the proposed project in India and evaluate its feasibility. So first and foremost, I will have to prepare over here the profitability statement over here, right? To essentially identify what will be my cash flow after tax year on year. Once I have done that, then I will obviously need to incorporate and find what will be my forward rates. Once I have found my forward rates, I will be able to find every year how much is the repatriated amount, and then I will be able to discount those repatriated amounts to identify the project outlay. So what are the things to be done? First of all, I will have to first prepare profitability statement, right? Profitability statement for what purpose? I want to find CFAT, right? Then second, once I have found CFAT, remember every year I am going to do the repatriation, right? For every year repatriation, I will need to calculate forex rate. So second part is calculating forex rates. Third part is repatriation based on these forex rates. And fourth is, once I get all the amounts, I get all the repatriation amounts, I'm going to do the discounting, right, to find PV cash flow and then do the comparison whether the NPV is positive or negative. Okay, shall we start?
Yes, sir.
All right, let's start now. So, first, initial investment in USD. How much is my initial investment? I am told my initial outlay of rupee 8 million, right? So, initial outlay, this is given to you in rupees. Million, that is 80 lakhs, am I right? Lakhs. That I will add additional working capital, that is 10 lakhs. Total outlay in rupees 90 lakhs. What is the spot rate? Yes, total outlay in USD will be how much? 90 lakhs divided by
72.
72, right? Because here I will say USD 1 equals to rupees 72, right? You are going from up the ladder or down the ladder? This is USD 1 equal to 72, so it is basically 72 upon 1, right? So from INR, you are going to go into USD. So from numerator to denominator, so divide, right? So I get $125,000. That is my initial outlay. Now, before I go further ahead with computation of profitability, I need to first of all calculate what will be my CFAT. So for CFAT, I need to compute over here. So cash flows after tax. So how do I calculate that? I am given sales, variable cost is given to me. Do I have the selling price? Yes, sales is 80,000 units. 80,000 units multiplied by, what is the price? 100 rupees. 80,000 into 100. Okay. All right, less are the costs which are there? There is variable cost of production. Variable cost is at rupees 30 per unit, right? Is 30 per unit. Okay, so we'll do 80,000 into 30. So I get 24 lakhs as a cost. Further, you are told there is additional fixed cost, 500,000. So that is 5 lakhs, right? This is a given information. Any other cost which will have? Depreciation. Yes. How much will be the depreciation? We have already done the working over here, remember? 8 million minus 2 million, so it is
1.2
lakhs minus 20 lakhs divided by 5. So I have 12 lakh rupees as depreciation. So earnings for tax is how much? 80 minus 24 minus 5 minus 12. So I get 39 lakhs. Right? Now from that I will say less tax. At what rate? At 34%, am I right?
Yes, sir.
So here you are given tax rate is 34%. 39 into 0.34. So I get earnings after tax, EAT. $25 lakh 74,000. Should I be adding anything back for CFAT? Yes.
Yes, sir.
What do I need to add? Depreciation.
Yes, sir.
So I get CFAT is 37 lakh 74,000. Next is I need to calculate how much will be the amount which will get repatriated, right? So I'm going to calculate over here. Repatriated every year. So how much is the amount? CFAT rupees. How much is that? 37 lakh 74,000.
77.
So all the 5 years you will have the same amount. 37 lakh 74. All right. Now I need to calculate over here. Remember, repatriation is happening every year. So I need to calculate over here what will be the forex rates. So what was my original forex rate? 72 rupees, right?
Yes, sir.
72 rupees. So rupees in the numerator. So I'm going to multiply this with inflation number of India first. What is the inflation number of India? What is the inflation number of India?
9%.
US is 8% and India is 9%. So I will say 1.09 divided by 1.08. Right? So I get after 1 year. Then after 1 year into 1.09 divided by 1.08. So for the subsequent years, this is how I get, right? I keep on multiplying 1.09 divided by 1.08, right? And I will get it for the 5 years. So I get the forex rates for the 5 years, right? Now I am getting over here because I am on Excel, so I am getting 4 decimal points or 5 decimal points. You may take it till 2 or 3 decimal points at best. Don't need to take 5, 6 decimal points, okay? Alright. Now I need to calculate amount repatriated, right? Repatriated in USD. So how much will be the repatriation in USD? Should I do multiplication or should I do division? Up the ladder or down the ladder?
Down the ladder, sir.
INR upon USD. You are going down the ladder. Down the ladder is divide, right?
Divide.
So 37 lakh 74,000 divided by forex rates. So I get repatriation in USD for the 5 respective years. Are you with me?
Yes, sir.
Now, the next part obviously is I want to calculate what is the NPV, right? In the examination, do I want to keep doing the same thing again and again? And the answer is no. So how do I save my time? So pay attention what I am going to do over here. At the end of the 5 years, yes, I'm going to redeem all the or repatriate all the profits. But the end of 5 years, project is over, so even the whatever capital is re-released, right? That also will be repatriated. Do you agree with me? So at the end of the 5 years, what is also going to come through is yes, salvage. Similarly, working capital released. Am I right?
Yes, sir.
Okay. All right. How much is going to be my salvage? You are told already in the very first information itself. How much is your salvage?
Yeah.
2 million, right? So that is 20 lakhs. Working capital released is how much? Do you have any working capital released?
1 million.
1 million, because you had invested additional one-time additional capital of 1 million. So that will also get re-released, right? Now this is all happening at the end of the 5th year. So exchange rate will be same as end of the 5th year. Am I right? Yes.
Yes, sir.
Okay. All right. So these are the total USD values which are going to get repatriated. Okay. Now I need to just multiply over here with PV factor at the rate of, what is the PV factor at rate? What is your required rate? Your required rate of return is 8%. Am I right?
8%.
That is 8%. You are given the numbers already over here at the rate of 8%. So it is 0.926, 0.857, 0.794, 0.735, and 0.681. Now remember, salvage and working capital is also coming at the end of the 5th year, right? So again, I will use the same 0.681, 0.681. Okay, so what will be my present value of cash flow? Multiply your repatriated USD into PV factor. So this is my present value of cash flow, 230,993. From this, I will say less initial cash outlay in USD. Remember, all these are in USD, right? This PVCF also in USD. So how much was the original investment in USD? 125,000. You got it from note 1. Okay. Note 1. $230 minus 125. I get 105,993. This is my NPV. So should I accept the project? Was my suggestion being asked over here?
Yes, sir. Accept the project.
Yes. So remember, as I told you earlier also, even if you are not sure, it's always better. वैसे ही मैंने calculate किया है, as it is I have already calculated. So put your suggestion in place. You will not be getting a deduction of marks. But if they have asked for advice and you have not given, you will simply lose the marks, right? So since the NPV is positive, what is the name of the company? Doesn't matter. The project be accepted. Okay. All right, everyone, through?
Yes, sir.
All right. Now there is one last question which is remaining. So let us get through with this. You will find a lot of the concepts which we have already covered are there in this question as such. So nothing new coming out except how this has been essentially designed, right? This question is basically about how this is designed. Rest, everything is something which we have already covered. So let's see how to go about it. A proposed foreign investment involves creation of a plant with an annual output of 1 million units. The entire production will be exported at a selling price of USD 10 per unit. At the current rate of exchange dollar, cost of local production equals to USD 6 per unit. Dollar is expected to decline by 10% or 15%. The change in local cost of production and probability from the expected current level will be as follows. Decline in value of USD in percentage, 0, 10%, 15%. Reduction in local cost of production USD per unit. So here you will have no change. Here you will have 0.30 and here you have additional 0.15 reduction in local cost. And then you are given probability. The plant at the current rate of exchange will have a depreciation of USD 1 million annually. Assume local tax rate as 30%. You are required to find out annual cash flow after tax under all different scenarios of exchange rate. Which three exchange rates are there? There is either no change, or there is a 10% decline, or there is a 15% decline. So you have to calculate under all three different scenarios. Expected value of CFT, assuming no repatriation of profits, and then viability of the investment proposal, assuming an initial investment of USD 25 million on plant and working capital with a required rate of return of 11% on investment, and on the basis of the CFT arrived under option 2. CFT will grow at 3% per annum in perpetuity. So here we are again, this is something which we have done, remember, indefinitely or in perpetuity. We have calculated that in one of the questions, right? So similarly here also you are told that growth will be a constant growth of 3% per annum in perpetuity. So we can use that constant growth model over here to find the value in that. Let's start. First of all, we will need to calculate what will be the profitability, right? CFT under all three options. So let's calculate the annual cash flows. Calculation of annual cash flows, right? So first option is no change. Second is 10% decline in USD, right? And third option is 15% decline in USD. Okay. Right. Now you have to start calculating the what will be the sales, right? So first of all, for here, my annual sales will be how much? What are my unit sales? I am told it will be 1 million units of annual output, right? The very first line. So 1 million output. So this will be 1 million, that is 10 lakhs, right? Into what is the price at which I am going to sell? $10. So I am going to first of all compute for the first one, which is no change. Okay, I'll complete that one to make my life easier. Okay, then I say less cost. Also, you know, sorry. All right. Next is exchange dollar cost of local production. So say for example, variable or production cost, right? Language uses production cost. Production cost is $6 per unit. So obviously it is a variable cost, right? This is $6. So that becomes 60 lakhs. Next, less depreciation, right? We know depreciation. What will be the amount of depreciation? We are told it will be 1 million annually. 1 million, that is 10 lakhs annually. Are you with me? So far, so good. Okay.
Yes, sir.
Now, earnings before tax. I will say less tax. I'll get EAT. Then I will say add depreciation. So I'll get CFT. Am I right? Okay. So earnings before tax will be how much? Sales minus the two costs. So I get EBT. Tax is at the rate of what percentage? Local tax rate is 30%. So 30 lakhs into 0.3. So my earnings after tax is 21 lakhs. Add depreciation back, so that is 10 lakhs. So CFAT will be 21 plus 10, 31 lakhs. This is if there is no change in USD value. Are you with me?
Yes, sir.
All right. Now, pay attention. My no change is already done. So now I need to essentially work on what will be my annual sales. If there is 10% decline in USD, I'm not going to make any changes in the sales price. So that remains the same. For 10% decline in USD. Production cost. Are you told something about production cost? There is a reduction in production cost, right? By how much? 0.30. So here, in that case, you will say it will be 10 lakh units into 6 minus 0.3. Am I right? It will become 5.70. Are you with me?
Yes, sir.
Okay. Now, very important aspect. Please note. Please note. Depreciation is 1 million USD. But USD is depreciating by 10%. So that means, what will be the value for you? USD is depreciating by 10%. That means it will be, how much will be your depreciation? It will be 9 lakhs. Are you with me? समझ में आ रहा है क्यों?
Sir, please explain once again.
Yes. So your depreciation is 10 million, 1 million USD, that is 10 lakhs.
Yes, sir.
And USD has depreciated.
Yes, sir.
So say, for example, my local currency is rupees. So I'm basically looking at rupees to USD, or it could be any other currency. Okay.
Mm-hmm.
But I am not the home country.
Yes, sir.
So I have my currency is, say, for example, rupees. And this investment which I am making in another country is, because it's a proposed foreign investment, that is in 10 million. Now, USD is going to depreciate. So this amount is fixed amount. Depreciation is a fixed amount of 10 million, 1 million, right? 10 lakhs. हारी बात समझ में?
Yes, sir. Yes, sir.
So ये अब depreciate होगा. तो मेरे बुक्स में जब मुझे convert करना है, तो वो कितने पे होगा?
Depreciated amount पर होगा.
It will be
यानी
a depreciated
जो
amount.
amount USD जो depreciate हुआ 10% से.
Yes. So say for example, I mean just for your easy understanding. Say for example, this was the exchange rate was 70 rupees. Rupees to dollar was 70 rupees, and rupees appreciating, right? Dollar is depreciating by 10%. So उसका exchange value क्या हो जाएगा? 70 into 0.9. Am I right?
Yes, sir. Yes, sir. Yeah.
Because dollar is depreciating.
Dollar is depreciating, rupee is
Appreciating. Now
depreciating.
you will get, you will have to pay lesser rupees to buy $1, right?
Yes, sir.
Okay. तो अब मैं अब तक कन्वर्ट कर रहा था भाई 10 million dollars है, ठीक है? So I was saying 10 million dollars or 10 lakh dollars into, I was converting into INR, no?
Yes, sir.
Okay. 70 lakhs और 7 crores in fact. अब यहाँ पे अगर वही चीज मुझे करनी है तो क्या होगा?
अभी 63 से मल्टीप्लाई करना होगा.
हाँ, एग्जैक्टली, राइट.
यस सर.
क्योंकि ये मेरा कॉस्ट जो है, कॉस्ट तो मेरा यूएसडी में अगर आप देखोगे तो स्ट्रिक्टली स्पीकिंग योर कॉस्ट इज गोइंग टू बी 10 lakhs only, right?
Yes, sir.
So
Yes.
you will say essentially here it will be 10 lakhs into 63.
63.
तो अगर आप देखोगे इसको कंपेयर करोगे तो मेरा कॉस्ट कितने से घट गया? By 10%. So for me, because I am an INR guy whose currency is appreciated, so for me depreciation has reduced by 10%. Are you all with me? समझ में आ रहा है ये?
Yes, sir. Now clear, sir.
Okay.
Thank you, sir.
Okay. Now, what will be your EBT? So, EBT मेरा कितना हो जाएगा? 1 crore minus 57 minus 9 lakhs, right? So, my EBT is 34 lakhs. You can see over here, EBT has increased by 4 lakhs. Tax is at 30%, right? At 30%. So I get earning after tax, I add back depreciation, my CFAT is 32,80,000. अब अगर आपको समझ में आया है, मैंने यहाँ पे depreciation का adjustment किया, production cost का क्या किया, तो let's repeat that again with 15% decline to check if you have really understood. My sales is not going to change, that is going to remain 1 million units into $10, right? So उसमें कोई change नहीं आएगा. Production cost is going to change. Production cost कितना हो जाएगा? Yes, production cost कितना हो जाएगा? 6 minus
0.45.
0.45. Very good. Additional cost है, right? So it is not just 0.15. It is 0.3 plus 0.15. So 0.45. Very good. All right. अब यहाँ पे depreciation कितना आएगा? You compare with the original, and then it will be how much? Decline है ना? So I will say 1 minus how much? 1 minus 15%. Or in other words, into 0.85. ठीक है? Everyone able to follow?
Yes, sir. Yes, sir.
All right. So then, now I have to find over here 0.1 annual cash flows. Then we are asked expected value of CFAT assuming no repatriation of profits. Okay. Expected value of CFAT. वो कैसे मिलेगा मुझे? For the 3 options, how will I multiply that? I have to say this will be nothing but CFAT under the 3 options into the probabilities, right? आ रही बात समझ में? आपकी probabilities क्या है इसके?
0.
क्या दिया था हमें क्वेश्चन में?
0.4, 0.4 and 0.4.
0.2, right? So I will say how much is the expected value of CFAT? Expected CFAT कितना है आपका? Equal to 31 into 0.4. Right? So total expected value of CFAT कितना मिलेगा? This plus this plus this. So it is 32,26,000 USD. ठीक है? This is my second part. And then the final part क्या पूछा है उन्होंने? The final part they've said is expected viability of the investment proposal, assuming an initial investment of USD 25 million on plant and working capital with a required return of 11% on investment and on the basis of CFAT arrived under option 2, यानी कि ये 32,26,000. The CFAT will grow at 3% per annum in perpetuity. So what is going to grow at perpetuity? You are told this is 32,26,000, which is expected CFAT, right? For each year. तो हम कैसे कैलकुलेट करते हैं वैल्यू? यस, कांस्टेंट ग्रोथ फॉर्मूला यूज करोगे यहाँ पे.
Yes, sir.
P0 is equal to
D1, sorry,
expected cash flow, right?
expected, yes, sir, yes, sir.
Expected cash flow
So,
1 upon KE minus G.
C.
एक्सपेक्टेड कैश फ्लो 1 कैसे मिलेगा आपको? यस, हाउ डू गेट D1? What is D1? D1 is D0 into 1 plus G. Am I right?
Yes, sir.
So आपको ऑलरेडी मालूम है my cash flow is 32,26,000 जो मैंने कंप्यूट किया है. This will grow at 1.3 growth rate, right?
Yes, sir.
Into 1 plus G कर दिया ना. अपॉन KE क्या है यहाँ पे? KE
11%.
दिया है 11%, right? Minus
Minus 0.3.
3%,
3%, sorry.
right?
Yes, sir.
So what is the CFAT I am getting? So expected value of CFAT of inflow CFAT in perpetuity कितना आएगा? डॉलर, close to $.
Sir, 41.53 end result actually.
ये फाइनल आंसर बता रहे हो बेटा आप?
Yes, sir.
हाँ बताइए प्लीज.
4153
4153
4750.
4750. सो ये आ रहा है 4,15,34,750.
Yes, sir.
Am I right? हमें रिमेम्बर यहाँ पे एनपीवी फाइंड करना है. तो ये तो मुझे टोटल वैल्यू मिला लेस. क्या करूंगा मैं? मुझे बोला है उन्होंने व्हाट इफ इनिशियल इन्वेस्टमेंट. सो लेस इनिशियल इन्वेस्टमेंट कितना है भाई? 25 मिलियन.
25 million.
मतलब कितना होता है 25 मिलियन? सो 30 and 25.
Yes, sir. Yes, sir.
तो ये हो गया 2,50,00,000. सो आंसर आएगा 165
34750.
50. दिस इज माई एनपीवी, राइट? पॉजिटिव है. सो व्हाट शुड बी माई रिकमेंडेशन? Since
Accept the project.
NPV is positive, accept the project. Right? Has everyone got this?
Yes, sir.
It's 10:02, but I will take 5 minutes more, please. Just 5 minutes more, beta. Has everyone gone through this? हो गया ये?
Yes, sir.
All right. Now, in the previous session, I'm going to take you back to the start. Remember, we had discussed this over here. How to raise funds. So we looked at equity by ADR, GDR issue. We have looked at capital budgeting, right? Where we have looked at international projects using both IRP and PPP wherever we were using home currency approach as such, right?
Yes,
Then we
sir.
looked at working capital management also. And then dividend decisions. Dividend decisions basically is all about how to, from an organization point of view, we had discussed that also last time around. It will depend on whether you are able to generate a return which is greater than cost of capital or not. If R is greater than K, then you will obviously want to retain the returns, right? On the other hand, if R is less than K, then it makes more sense to distribute the money so that you tell the shareholders, "आप लोग invest करो, you invest on your own because you will be able to generate better returns compared to what the business is able to generate for you." So that might be the main aspect. However, one aspect which remains in dividend decisions is the key stakeholder, right? So a key stakeholder, say for example, if your main promoter is getting taxed at the highest rate of tax at 30% or 35%, even if R is less than K, he might essentially prefer to have lesser amount being paid out as dividend because he would prefer to take that dividend in the form of your difference in the value of the shares, right? To take it as a capital gain, because capital gains will attract a tax rate of only 10%, while dividend will attract tax rate of 30%. So this aspect can also become an important consideration. Okay. Now, one aspect which I wanted to cover today after this is you have one concept of gift city. You all know what is gift city, right? Which has come up in Ahmedabad. So just to give you an equivalence, in London, they already have this particular one hub, financial hub being created, right? Wherein a lot of tax savings and tax benefits are available so that international people or international labor force, workforce can essentially move over there and can essentially do business with very favorable terms. The legal compliances, etc., will be bare minimum. And in order to compete with the world as such, we have also created a financial center, which is Gift City, which is going to encourage investments and also professionals to come in and essentially have a good work-wise, the climate which they want, which will be available over there. Now, a lot of the laws, lot of the rules and regulations pertaining to company law as such are being dispensed with or have been reduced substantially if somebody is starting a business venture in gift center. Of course, there are certain obligations as well onto them in terms of that if you're coming in over here, then you will need to have, because it is created like a SEZ, right? Special economic zone. So you will obviously, all the sales predominantly will amount to international export-oriented unit kind of, right? So that is obviously going to benefit the country as well because it becomes a good way to attract dollar investments, foreign exchange, and also encouraging more exports from India, right? So this particular city, or rather the provision, the notes have already been mentioned over here, right, in your module as well. So you may please go through it, but it is one of the very, very important legislation which has come through in the last few years and will become more significant in the years to come. So with that, I will conclude my session on international financial management.
Thank you, sir. Your session was very informative, especially regarding your briefing on the regarding your especially your session on briefing on a gift city is a very knowledge very knowledgeable. And so far as the topic is concerned, foreign exchange risk exposure and international financial management. Now, both topics are very important topics from the examination point of view. So we come, students, we have come to this end of this topic. Of course, Amit sir has explained all the topics in very much good detail. Still, you have any doubt, you can ask us. Amit sir, just share my contact number as well as telephone number.
Should I mention it over here? Wait a moment.
You can mention it on your screen, please, sir.
Okay, just 1 minute.
I just noted down, noted down to you.
Yes, sir.
Sir, my contact number is 0120.
Just 1 minute.
No problem, no problem. Zero 0120 3045 956. Okay, or you can send us email at sfm-final@ICAI.in. Of course, you can also send your queries at a mobile app, through mobile app as well. So, student, thanks for patient listening for these sessions, and now we shall continue our series of this lecture for the next topic, and next topic will be interest rate risk management. So, students, see you in the next class and revise whatever has been covered here. Of course, there is some notes or solution of some questions are pending from the foreign exchange exposure risk management. Sir, is there any question is pending from this session, or all questions have been completed?
Sir, in this session, all 11 questions have been solved.
Okay. So student, only some question that has been given for the homework in the last topic. We will upload the solution of the same questions very soon. Thank you, Amit sir, for sparing your precious time and enlightening the student on this topic. Thank you, sir. Thanks a
Most
lot.
welcome. Thank you.
Okay, student. Thank you. Have a nice day.
Thank you, sir.
Thank you, brother. Thank you.
Thank you, sir.
Session over.
Thank you, sir.
Thank you, brother. Thank you.